Okay, so ultimately we're trying to look at what stocks and bonds are, but I want to place them in the perspective of where they go. So, okay, you've got a budget. You're got a job, you're making money, and then you have certain bills that you have to pay. So after you've met all your obligations, you have money left over, hopefully. And if you have money left over, you can just spend it, you can blow it, it's gone, or you can save it. So buying stocks or bonds always comes in the category of it's got to be money that you're saving. You can't risk the money that you really need to live on. So it's money that it's over and above what you need to live on. So if you save it, you have a number of choices. The question is, where do you save it? You could save it, you could put it into stocks or mutual funds. These are called securities, and they have to be bought from a licensed securities broker or securities firm. You can join Scottrade or Ameritrade or these different places where you basically they become your broker. And so instead of calling an individual live broker, you do work through an internet app that you have or whatever. But that is an official. That company has made itself an official representative. So the point is, to buy stocks or bonds, they're securities. You've got to buy them through someone that's licensed. You can go to a licensed broker, or you can get Scottrade or Ameritrade or one of these apps, which are made by investment brokers. And so, so stocks, mutual funds, and bonds are things you can buy. There's also a long-term places to put that money, and all of you should be thinking about systematically preparing for your retirement, because when you get old, Social Security is not going to be enough to cover your needs. And so typical investment vehicles in a company would be 401k, or you can have your own individual retirement account that you set up. These are both tax deferred, which means that the money you put into them reduces your tax load. So if you make $100,000 and you put $10,000 of it into a 401k, you really only make $90,000, because the $100,000 you made when you put $10,000 of it into the 401k, you're really only taxed on $90,000, because the money you put in here is tax deferred. It's not taxed until you take it out in your retirement. The Roth IRA is a little bit different in that the money you put into it is taxed. So if you make $100,000 and you put $10,000 into a Roth IRA, you'll still tell the government you made $100,000. But then when you take the money out of your Roth IRA in retirement, it's not taxed then. And that would probably be pretty sweet, because as an older person, usually you're making less money than you did when you're working. So now you're not taxed. Whereas if the money you take out of a 401k or an IRA, once you're older and you're in retirement and you're taking that money, it's taxed when it comes out. So you got to choose whether you want to pay the tax going in or when the money's coming out. So those are long-term investments. Let's go back here to stocks. So what is a stock when you buy a stock? Okay, so basically a company, IBM, Apple, Google, they decide to go public. Before the company goes public, they're just private. There's no shares. You can't buy it, but it's it's your own hamburger stand, and maybe you make it big, and now it's 100 hamburger stands. It's still your company. You make all the profits, but to get more money, you might want to make it go public, which means you sell shares in your company. You lose a little bit of control, because everybody who buys a part of your company and they get a stock certificate for the amount of your company they buy, they actually have a say in your company, because now that it's public, you might end up losing the company because somebody might buy so many shares that they have a controlling interest. So the point is, every time you buy a share of a company, you are an owner of it. Now, most of us, we buy a few shares of Coke or a few shares of Apple or Google. We don't really have much say. But in theory, we are a part owner of that company, because when you buy stock, that's what you're doing. So generally with stocks, then, so let's talk about how you would pick the stocks that you're gonna buy. One would be looking at the risk. So anything you buy, there's a continuum of low risk all the way to high risk. Okay, so a bank CD is probably the least risky. You put money in, you know that in 15 months or whatever the maturity term of your investment, you're going to get so much back. So you put $1,500 in now. They promise you $1,700 at the end of the 18 months that you put it in. Typical maturity for a CD, a certificate of deposit that's called with a bank. You can go to your bank and say, I'd like to get a CD. You'll give them $1,000 and you know that after 15 months it's going to be $1,200 or whatever they're giving you. So those are safe. That would be safe. A savings account makes almost no interest, so it doesn't make much sense to put money there because it used to be savings accounts made like 5%. That's not bad. Those days are gone, okay, at least for now. And then at the very high end, junk bonds, they might promise we'll give you a 30% return, but it's a company that's, it's a junk bond because they're not rated real high. There's a good chance they could go out of business. So if they don't, you might make 30%. So you did really good, because usually investments that are high risk are also high return if they work. So if you buy junk bonds and it ends up paying off, you'd be fine, but the company could go broke. So that would be penny stocks is another thing. Some, whereas Apple sells for $1,000 a share or whatever, some stocks you can buy for like 56 cents a share. They're called penny stocks, and those companies sometimes could take off, and that share that's now 56 cents might be worth $56. You'd make thousands of times the amount you put in. So some people want to invest in penny stocks, but the problem is most penny stocks don't take off as companies. So you'd have to really do your research, and if you're going to buy some penny stocks, really cheap stocks, see what that company, what the future of that company is. And then stocks and real estate are both kind of in the middle because, depending on if you buy a blue chip stock, that's a pretty safe investment. Apple's not going to go out of business anytime soon. And so money you put into Apple, that's a pretty safe risk. But, but the whole economy, Apple included, can go up and down. And so, your money's at risk a little bit if the economy goes down. Real estate's the same thing. In the 70s, gangbusters, and 80s, things appreciated. Houses appreciated. You buy it at 150, now it's worth 200,000, now it's worth 250. That was a very good investment. But then we had that, the real estate market tanked in recent years, and it's slowly coming back. So those, you've got to think of the risk reward factor when you think about buying a stock. I like to, if I buy a stock, I like to buy something I believe in. Like when I bought Facebook, and it went down. I think I paid $40 a share. Like in a couple of days, it was down to $20 a share. I lost money, but I didn't care because I was investing in something I believe in. Facebook's something that grandmas use. They show pictures of their kids online. More people are on Facebook than there are people in the United States of America. It's a huge way to communicate. So I believed in that. Now I've made a lot of money because I bought it for $40 a share. It's around I think it's around $200 a share now. So every share I bought for $40 is now. I've got $200. So that was a good one. So some of you might want to think about Snapchat is going public. Right now, Snapchat's a private company. Any money they make, it's just theirs. But to get more money, they're going to go probably in March, going to go public, which means you can buy shares of Snapchat. The actual company is called Snap. So, that's an IPO, an initial public offering. When a stock is sold to the public for the first time, that's called an IPO. Let me write that down. An IPO, an initial public offering. So Snapchat, the name of the company is Snap, they're going public in March, and will that be like Facebook? There's a debate about it. I've given you some stuff to look at there. Mutual funds are very safe. I should have put those over here in the risk reward category. They tend to be low because whereas stocks can go up and down, you buy individual stocks, they go up there. When you put a whole bunch of stocks into a single package, it's sort of like a playlist. Instead of just one song, two songs, you've got this whole playlist of songs. There's a group of stocks and bonds that are in a mutual fund. So when you buy one mutual fund, you're diversifying your portfolio. That's a good thing to do, is diversify. Don't put all your eggs in one basket. Don't have everything in one stock. So diversify, if you buy a mutual fund, by definition, you're now diversified. If you were buying individual stocks, it could be expensive. You buy, one share of Apple, it's $1,000. So, maybe that's all you can afford. So you got one share of Apple. Well, if you buy $1,000 in a mutual fund, now you're not just stuck in one. You've got a variety of things, and you made one investment. You really invested in a whole bunch of things because that's what a mutual fund is. Okay, bonds real quick. A bond is basically a debt. The government needs money. So when you buy a bond, basically you're loaning your money to the government. So a typical thing might be, if you're a big shot, you give $900,000 and the government promises they'll give you $1 million back in 3 years or whatever. So that's what a bond is. You're giving money. So here's my $900,000. Why am I willing to do that? Because I'm going to get $1 million back in 3 years. So then the government has money to work with. They take that money, you just bought their bond, the government has money, they can build roads, do things, whatever they want to, but they're going to have to pay you back more later. So that's why a junk bond could be dangerous, because the company might fold. Now, the United States, because we're so strong, we've never folded as a country. You know, it's considered a safe investment. So when you buy a government a T-bill, that's very short term, a T-note or a T-bond. A T-bond is 30 years, a T-note would be 2 to 10 years, and a T-bill could be very short. It could be even just a few weeks. So you give a little money now, you're going to get more back. Okay, and I think I'll finish up. Another way to evaluate stocks is to, besides knowing about the company, you can do research on the company, is look at the historic performance of the stock. And so there's a lot of places online where you can find, you look at a stock and it'll show you the historic chart, what it's done in the past 30 days, what it's done in the past year, what it's done in the past 5 years, what it's done in the past 10 years. You just manipulate the chart online and you can study. And you'd want to see that because, you know, there's all kinds of different patterns that you might see like this. So if the stock had a pattern like I'm drawing right now, and it was down here, well, since it was up here one time, you might want to buy it when it's low, hoping that it goes back up. If you buy it up here when it's high priced, then it's going to go down, you lost money. If you would have bought it over here, then it appreciated and sold it up here, that's where you would have made the most profit. But then if you held on to it, now it's back down to about what you paid for it. But if you bought in here, you'd kind of hope that it's going to go back up. So looking at the historic performance of a stock can give you an idea of where it's been, and that can let you know if you want to invest in it. You can also look at stock tables, and I'll show you those in class. Okay, so be a wise investor.